Hey everybody, Felix Staffelbaker here. I've got a article here to show you that is from Bloomberg. It says it's the $65 trillion in debt you can't find that'll get you. Accounting conventions have hidden immense amounts of foreign exchange liabilities. We might not know where they are until the next crisis. This is from December 5th of 2022 from Bloomberg. $65 trillion is not a big number. It's a huge, barely comprehensible number. It's more than 2.5 times the size of the entire U.S. Treasury market, the world's biggest. It's 14% of the value of all financial assets globally, according to a tally from the Bank of International Settlements. It's also the value of hidden dollar debt unrecorded on the balance sheets of non-U.S. banks and shadow banks as of June this year. Also, according to the Business of International Settlements, the central banker's central bank. It has grown and been growing rapidly and has nearly doubled since 2008. The fact that most of this hidden debt is owed to banks is another reminder of the ever-growing and opaque interconnections between the traditional finance system and the shadow banking sector. A whole set of recent mini-crises has shown that these links are part of why central banks keep being forced to step up and stabilize government bond markets and other assets when stress levels rise. This $65 trillion of debt we're talking about isn't a set of straightforward loans or bonds. It's the repayment obligations on foreign currency swaps and forwards. These are typically used by foreign banks and investors when they want to buy a dollar-based asset like a U.S. Treasury bond. Swaps and forwards are fully collateralized, so ought to be relatively safe for the counterparty. When someone uses a swap to borrow dollars, they in effect pay for them with their own currency and make a commitment to sell the dollars back at a certain date in the future, most often in less than a year. The trouble comes when dollars become difficult to source, especially as borrowers often use short-term swaps to buy long-term assets. Examples of such moments are the start of the COVID-19 pandemic in March 2020 or the peak of the 2008-2009 financial crisis. A global squeeze on dollars left foreign owners of dollar assets scrambling to find the funds they needed. Otherwise, they'd be forced into selling good assets quickly and adding to the downward price spirals. Central bankers ideally would like to be able to see these strains coming from before they hit. In 2020 and 2008, the Federal Reserve used massive currency swap lines and other major central banks to get dollars out into the world and calm the chaos. But because these flows are hidden off balance sheet, no one really knows where in the world to find all of the forex swap and forward debt. Neither does anyone have a better way to stop waves of dollar shortages from becoming destabilizing in the first place. The BIS first studied this problem in 2017 and updated the report on December 5th, warned about the difficulties for central banks of setting policies to deal with dollar squeezes while in the fog of a crisis. Off-balance sheet dollar debt may remain out of sight and out of mind, but only until the next time dollar funding liquidity is squeezed, wrote the authors led by Claudio Borio, head of the BIS's Monetary and Economic Department. Central banks have to wait for the chaos to erupt before they know where and when the dollars are needed. And even then, they might not be able to entirely sure if they are directing the flows where they are required. This debt is not recorded on balance sheets due to the accounting conventions for derivatives. These allow banks, pension funds, insurers, and so on to book only their net exposure. With a forex swap, the initial net exposure is zero, and it will only move up or down as exchange rates change. This accounting treatment is fine for most kinds of derivatives that can be closed out with a cash settlement of only the net value of the contract. With forex swaps and forwards, however, the full amount of dollars owed has to be found and repaid to the counterparty to close out the trade. That's what makes them more like debt. Hidden debt of shadow banks. Non-bank financial intermediaries outside the U.S. have forex swaps and forward liabilities that are double their recorded dollar debt. The BIS has improved the data available, but it's a long way from perfect. The study shows that shadow banks, or non-bank financial intermediaries, to give them their official name, have increased their dollar swap and forward liabilities to $26 trillion. That's twice the size of their on-balance sheet dollar debts. Non-U.S. banks have $39 trillion of similar liabilities, more than double their on-balance dollar debts. Unrecorded bank debt. The non-U.S. banks have almost $40 trillion of hidden dollar liabilities from the forex swaps and forwards, nearly 3 times their recorded dollar debt. These are all sourced from the Bank of International Settlements. These numbers are derived partially from the BIS's triennial Global Derivatives Survey, but the economists still don't know exactly how these debts are spread among different kinds of shadow banks. The Global Financial Stability Board and others are becoming more focused on the issue of hidden leverage because of its ability to cause sudden waves of stress that cascade through the markets to threaten the global system as a whole. The BIS is also concerned about the lack of transparency and the exposures of the banking system to the shadow banking world, and a worry that we've written about here too. Years of ultra-low interest rates and investors' aggressive hunt for returns have driven leverage higher, and the growth forex swap and forward liability is one mammoth example of that. Rising rates and volatile asset prices make high leverage a dangerous source of instability, and even more so because it's hidden. More transparency would be wise for forex swaps and forwards in particular. Accounting changes could also be useful. Repurchase agreements or repos where bonds and cash are exchanged are also reported on a gross basis rather than on the net basis of derivatives. Maybe these currency debts should be too. And that's pretty much it. That's this article. There's other articles from Forbes has one. And then also the Intel Economics also has one. I mean, these are no joke. Everybody knows that this is a thing. Everybody knows that there's 65 trillion at least that they're willing to admit in debt that's going to hit the dollar, and it's going to blow up the whole world. It's all being orchestrated so that it can be systematically gamed and used for the benefit of the banks at the expense of the many. And I mean, we already see that China and Russia and the BRICS nations are going around the US dollar. They're getting out of the dollar, so as the demand for the dollar wanes and you can't start to trade these forex things with the dollars, it's going to start to create even more systemic crisis all around. And they even said in the article, we don't know where the crisis is going to come. We have to wait for the crisis to happen so that we can react to it, which means that you're going to be stuck on the hook if you're not already positioned in a spot ahead of time in something like Bitcoin that is a call option. It is a credit default swap insurance. It has no counterparty risk, and it gives you all the benefits of a real currency and avoids all of the problems out of that $65 trillion debt bomb. I mean, you could avoid that like the plague if you just had Bitcoin. I've made a video before. Bitcoin is the financial vaccine, the financial antidote for the globe virus that is fiat money. And so, I mean, we just go through this over the years. We've been literally saying all this stuff exactly the way it is, and now we can start to see that it comes out in an article like this, or they start to tell you, or it just starts to happen, and the people who are positioned in the right spots are the ones that are benefiting from it, and the people who are worried about other things in society that you're being told to worry about are being affected in a disproportionate way, and it just makes them more angry, and it's just crazy. So I just want to put that out there. There's a $65 trillion debt bomb that you can't find, but it'll get you. Stoffel Baker out.